Hi, this is Brad Levin, President and Founder of Legacy Wealth Partners. It's January 12, 2016. Thank you for joining me today. I'd like to take a few minutes to discuss with you the recent volatility we've been experiencing in the financial markets and to share our perspective on that. 2016 has gotten off to a really rocky start for the stock market. In fact, last week's decline marked it as the worst first week of the year decline since 1901. In last week's market action, the S&P 500 dropped 6%. The Dow Jones Index was 6.2% down, and the NASDAQ down over 7.2%. Meanwhile, in China, the Shanghai Index dropped a whopping 10%. Also on the week, oil prices declined 10% as well. There are a number of factors that have contributed to uncertainty and volatility in the stock market in recent weeks. However, in my opinion, last week's market slide can be attributed to two primary issues: China and oil. At the start of the week, the latest report on manufacturing activity in China indicated continuing slowness. This has been a concerning trend because investors fear that ongoing weakness in China could lead to global economic slowdown and perhaps even a worldwide recession. So the market opened weak on Monday morning after the release of this report. Then, regulators imposed a new circuit breaker system for the Chinese stock market designed to help combat the massive market moves their stock market has experienced over the past 6 months or so. Unfortunately, this system failed miserably. The system was designed to temporarily halt trading if the Chinese stock market dropped 5% or more during a single session, and to shut it down for the entire day if it reached a level of 7% decline or more. Well, the disappointing economic news that I just mentioned triggered a market sell-off that quickly tripped the circuit breaker system on its first day of use. As soon as the market reopened for trading after the circuit breaker was lifted, investors madly sold shares with a fury. The same thing happened one more time during the week before regulators ultimately decided to scrap the system altogether. Secondly, in an attempt to counteract economic weakness, Chinese leaders also guided their currency, the yuan, lower during the week. Now, to put that in perspective, a weaker yuan means Chinese exports become more competitively priced for foreign buyers. However, as the yuan weakens, the U.S. dollar would strengthen in comparison. The dollar has already rallied strongly over the past year, cutting into the earnings of U.S. corporations. Because today, U.S. corporations generate more than 40% of their earnings from overseas sales. So this has contributed to investors' fear of a weaker earnings outlook for U.S. stocks, thus sending our shares lower as well. In addition, last July 8th, Chinese regulators imposed a 6-month suspension on the sale of stock shares by large corporate insiders, those holding more than 5% of a company's shares. This was designed also to try to cushion some of the volatility they were experiencing. But with the expectation of the suspension ending last week, possibly leading to large Chinese shareholders dumping their stock, traders dumped shares to try to beat them to the punch. Finally, as I mentioned, the other major factor besides China last week was oil. Prices for U.S. crude dropped 10% on the week, coming down to as low as $32 a barrel because of, first of all, excess inventory buildup. Second of all, I see the weaker yuan as a contributing factor too. Remember, a lower yuan means higher dollar outlook, and oil is denominated in U.S. dollars. So as the dollar goes higher, or the outlook for the dollar at least increases, investors would fear that oil prices would decline as well, and traders have continued to sell oil to push prices down. In fact, at this point now, oil prices have been pushed so low primarily because new investors have entered the market on the short side, trying to bet on oil prices going lower and in fact creating a self-fulfilling prophecy. Now keep in mind that in the summer of 2014, oil was $105 a barrel. So having dropped by already 70%, the low price for oil is killing the profits for the energy industry. U.S. corporate earnings will register their third back-to-back decline for the fourth quarter just ended, further contributing to the weakness for stocks. With 2016 getting off to such an awful start, investors are naturally wondering if this could be the start of something big, along the lines of what we experienced in 2008. While anything is certainly possible, we don't see that as a highly probable outcome for several reasons. First, the U.S. economy continues to be relatively robust. While GDP for the fourth quarter here in the U.S. will probably register an anemic rate of 1% growth, the forecast for 2016 is for growth to be slightly over 2%. So nothing exciting, but also not contracting either, which is the important issue. With the unemployment rate now down to 5%, we are nearing full employment. The labor market is much stronger than it was in 2008. In fact, at the worst point during the recession, unemployment exceeded 10%. In the last month alone, we added 292,000 new jobs. Now, we could easily debate the quality of those new jobs being added, whether they were seasonal, part-time, or full-time employment, but we have added over the past year, on average, over 220,000 new jobs per month, which is excellent. Consumers, which account for 2/3 of the growth of our economy, are in excellent shape overall. Despite the recent weakness for some of the traditional brick-and-mortar retailers, retail spending during the holiday season did increase nicely. Auto sales also reached a record level in 2015. And in fact, we now have the highest level of net worth for American households collectively in history, while the ratio of income needed to service monthly debt remains near historic lows. So while we have extreme weakness in the energy sector and in basic materials, and we are now in a recession technically in the manufacturing sector, we are not in an economic recession, and we're not likely headed there this year. Also, we are not concerned that stocks are trading at very expensive multiples, as they were back in 2008. U.S. stocks are now trading for slightly less than 16 times forecasted earnings for 2016, and about 16.5 times the earnings that will be registered for 2015. This is right in line with the long-term average. Now, turning back to China for a second, we recognize that their leadership is having a tougher time transitioning from an economy led by government spending to one that is more driven by consumer spending, much like the U.S. But we do know that they have a lot of tools in their toolbox that they can turn to if needed to stimulate their economy further. So in summary, we do not see a 2008 scenario as a high probability. However, having said that, I do see that the weakness that we have recently experienced in stocks may continue for some time, and that higher volatility in general is returning to our paradigm. I want to share with you what we see developing in terms of the market environment right now from a technical perspective. Using charts like this is another way to gauge the health of the market behavior. And what I want to point out is that some of the weakness that we see coming into the market in the last several weeks has actually been bleeding into the market going all the way back to last May. Now you can see here that on this chart for the S&P 500 that the stock market reached a peak, in fact a new all-time high last May. But you can see here that after the market subsequently retreated after that peak, that every successive rally failed to surpass that level. A market environment defined as having higher highs and higher lows suggests a healthy, strong trend. On the contrary, an environment such as we've experienced suggests a weakening trend overall of lower highs followed by lower lows. I would not be surprised to see the market break through the low levels that we reached last August. In fact, a further pullback from where we are today of around 1925 on the S&P 500 of approximately 10% would fit with a typical corrective pattern. On the other hand, I do want to point out that oil prices, which have been a major headwind over the last year and a half, will not drop another 70% from here. They will stabilize somewhere around the current levels or shortly below where they are today. And once that happens, one major source of downward pressure on stock prices will be behind us. There are a lot of bargains out there that are being created in stocks right now, some great values. And after the current level of market panic subsides, we do see the possibility for the market to stabilize and finish the year with decent gains, probably in the mid-single-digit range. So given the volatility we're experiencing, what steps should you be taking right now? First, it's the same as I always say. You have to make sure that your portfolio allocation fits your personal needs and goals. The key is to understand the potential risk inherent in your portfolio, which you're accepting for the return you want to try to achieve. We have a very effective tool for assessing both your comfort level and your current portfolio risk and making sure that both are consistent with your personal needs and goals. If you would like to have this done for you, please contact us and we'll be happy to run that analysis for you. For many of our clients, we actively manage portions of your portfolio using dynamic risk management strategies which enable us to increase or decrease your stock market exposure in response to changing market volatility. In these portfolios, we in fact have already made adjustments to begin lessening the level of volatility. Hopefully you'll find that comforting and see the effect in your portfolio. Number two, we want to make sure that short-term gyrations don't ultimately allow you to shift your focus from your long-term plan. In fact, when we do financial plans for clients and we recommend an investment strategy, we know that times like these will inevitably come. We plan on it. So if we tell you that you have a high probability of reaching your financial goals, knowing that there is going to be volatility like this, This volatility occurrence doesn't change our perspective much at all. Third, if you have personal financial concerns or you'd like to get a checkup on your allocation or your overall financial goals, we are here for you and we're happy to talk. If you're listening to this podcast and you're not currently a client of ours, we'd be happy to talk to you as well. Simply contact us using the details on the next page, and we'll be happy to have you speak to one of our advisors. Finally, I have just scratched the surface here this morning. On February 9th, we'll be doing a much deeper dive into our 2016 forecast, sharing our perspectives on the opportunities as well as the risks that we see today, and also reviewing the recent year and the factors that shaped it. Please watch for our upcoming invitation coming to you soon, or contact our office for more details. Thank you for taking the time to listen to me today. You will find our office contact information listed here. I hope this has been beneficial for you, but if you have any additional questions or would like to talk further, please reach out to us. We're happy to talk to you.